Hello, everyone. I hope you all had a good Easter. This might have passed you by given the break that we had, but the ECB cut their interest rates again for the second time in a year. So, what exactly does this mean? Well, there's a brilliant article here written by Connor Pope of the Irish Times. There'll be a link in the email as well to it, but I'm just going to go through it with you, so you can understand it. And obviously, it's going to mean different things to different people. So we'll tease all that out. And obviously, I'm going to be available if anyone wants to have an individual conversation around it. Okay, right. So I suppose the first question that's always get asked, um, what does that actually mean, or who's going to benefit from it, right? Well, the first sort of people who are going to benefit immediately will be anyone who has a tracker mortgage, right? They're obviously going back 15 odd years ago now, but there's about 126,000 homeowners on tracker mortgage. So they'll see an immediate cut in the rate. The sort of knock on effects, though, will also mean anyone who's sort of coming off a variable rate and will be coming onto a fixed rate, are coming off fixed rates in the months ahead. They will basically, with the rates coming down, there should be lower rates on offer to them. Okay, so that's the sort of side effect. Obviously, the variable rate mortgage holders at the moment basically are, well, it's a slightly different thing. You're still at the mercy of the bank deciding to reduce their rate, but ultimately that's where the rate should go and the variable rates should come down. But that will be at the decision of the individual bank to decide when. Okay, when do the tracker rates come down? Well, within 30 days, basically. So what does that actually mean in terms of what you'll qualify for or house? Say, for anyone to track a mortgage, it's probably about €150 less per month than a year ago. And not this particular cut, but what's happened over the last year, okay? Variable rates, as I was saying, there's no direct correlation, but if the movement is downwards, that's where it's likely to go. So the key thing then in relation to people who are looking to buy homes, right? That's obviously very important for people who are looking to buy homes. Well, obviously their repayments based on the amount that they would borrow will most likely come down. However, my view on this is there's two sides to this. If the rates come down, more people are going to be interested in buying. And if there's more people interested in buying, that pushes the prices up. So there is a bit of a double-edged sword there. So for those who have agreed to buy new houses and just waiting for them to be built, there's absolute value in that, because if the rates are coming down, they'll be availing of the rate that is coming, that will be in effect at the time actually come to close on the deal. So what's going to happen next? Well, the market seems absolutely convinced that there's going to be further reductions. They actually think that the European Central Bank rate will come down to below 1.5%. The reason for that is, well, inflation is not such a concern at the moment. The biggest concern appears to be, and rightly so, is what Donald Trump is doing over in the US and the tariffs that he's basically putting on there, fearing that may lead to a recession. So now there's also an argument to be made, and this is one that it's not in this article, one that I feel if suddenly inflation prices go up, well as really could also lead to inflation, and that would push rates back up. So there is two arguments to be made here about rates. So like always, there's a bit of a crystal ball exercise. Now, when the rates were going up, I was always saying to people, well, don't be worried thinking about the rate right now. It'll be when you're coming to close. So you might, if you were closing today, you might take a a fixed rate because the rates were going to go up. But by the time your house was going to be built, and the expectation was that rates might come back down, which has happened, you might actually take a variable rate to avail of the reduced. So the same thing could happen here, that at the moment the rates are coming down, and they might come to a point whereby, okay, the rates have come down and now might be a really good time to fix. So there's a lot of kind of juggling to be done there, I thought, to be considered. Obviously, with the uncertainty in the world at the moment, sometimes taking a fixed rate for a long period of time is of great value, and you take a lot of the uncertainty out of it. Avant Money, and you'll see their ad there. They have actually got long-term rates that are really competitive, where you can actually take more a rate for up to 20 or 30 years. But they've now just introduced, I think I would have mentioned there, a new product called Flex Mortgage, which is kind of, I don't use the word lightly because it tracks the interbank rate. So with that coming down, their rates should come down as well. And currently, it's the lowest variable rate in the market. So currently, they've got a great offering on both the long-term security and the variable rate. But listen, if you're interested in having a conversation around this, and if you're either thinking you're coming off your fixed rate, or thinking of just switching, sure, there's a link to my calendar. Feel free to book a call. Otherwise, hope that was of great information. The link to the full article is in the email as well, so you can have a full read of that. But hopefully, you've all had a good Easter, and hopefully Donald Trump doesn't do anything crazy in the next month. Talk to you soon. Bye.